There comes a time when we must admit what's really going on, and it's not one or two retailers. It's a widespread epidemic which has not been felt in America in this generation. Look at the scale at which this is happening, and yet somehow ignored. Well, that's why you came here for the truth, so let me unveil that for you. Today we're going to look at the epidemic that is going on in the United States today regarding store closures. I will talk about the current situation, the past, and the present, and then cover some more information if I have time. After that, let's begin with looking at Sears. Sears will be closing more than 70 additional stores in 2018 as their sales continue to erode. They're talking about the details of the situation. They're talking about how many stores and what's going to happen and so on. But I don't want to bore you with all of the details. I want to talk to you about what's really going on and why this is happening. Many people credit the rise of Amazon and e-commerce to the decline in brick and mortar retail locations. We can see that primarily the stores that are closing tend to be either apparel, big box stores, or department stores. And so many people have said, look, it's Amazon, look, it's online retailers, they're putting them out of business. And definitely to some degree that is true. However, statistically, e-commerce makes up about 10% of the total retail sales. So I think that it's unfair to say that's the reason this is happening. It is my idea that it is in fact the economy that's weakening that is the true reason. That's my thoughts on the subject. The economy is truly at fault, not so much online retailers. Of course, that has played a role. There's no doubt about that. But 10% of total sales, it is a little too small to make it the main contributing factor. One of the issues that I have with all of these store closures is that, number one, a lot of people are going to be put out of business. A lot of individuals who haven't looked into the statistics will say, hey, don't worry about it, they'll find more jobs. But if you actually look at the numbers, you can see that a large amount of people are employed in retail locations. So if you start closing down all these retail locations, a lot of people start losing jobs. It's not just, one store here and there. We're talking about an epidemic. The other issue that I want to get into is pensions. In this case here, they're talking about how Sears, they are only 81% funded. And by the way, 81% funded is really high when you look at the United States and how this particular, comparison here shows us if Sears is going to be potentially cutting their pension benefits by 19%, well, what would happen in an area like Kentucky, New Jersey, Connecticut, where they are severely underfunded? Well, in this article here, they talk about the Pension Benefits Guarantee Fund. Of course, to have the taxpayer bail them out. That's the way it always works, right? You have a problem, don't worry, somebody else will pick up the tab. This is not really fair. I don't think that the pensions, should be bailed out by the taxpayer. I just don't see why that's the case. I'm not a fan of these to begin with. I have an issue with them. I think people should be investing in real assets instead of going into something like this pension. They shouldn't have it. The company shouldn't offer it. The government shouldn't have pension plans. I think that it is an outdated model. I don't think it's really working anymore. They're all becoming underfunded. And then we have a fiasco like this. Sears is one example. If you want to know much more about pensions, just type into a search engine or YouTube, the Money GPS pension. I have a whole list of videos on that. retailers closing stores in 2018, whether it's Toys R Us, Walgreens, or the big box retailers like Best Buy, even Gap. You're seeing that. That's a Banana Republic and Gap. Sears is on the list, of course. Walmart, Sam's Club is here as well. The list goes on. So these are just some of them, some of the bigger ones. But when you look at an example of Toys R Us, this is a store that was so popular, so pervasive at one point, and suddenly they're closing down. Big changes are happening. This article is talking about the situation with the malls. When anchor stores close, it can be hard to find businesses to replace them because they occupy the multi-story buildings at mall entrances that are often at least 100,000 square feet. If no replacement tenant is found, the loss could trigger a decades-long downward spiral for the shopping mall and the surrounding communities. Communities wither away and they never come back. When anchor stores are boarded up, traffic to the retailers in the middle sections of the malls tends to decrease. That's been happening in shopping malls nationwide, and now many retailers are going out of business and closing their stores as a result. There are countless empty malls in the United States today. Not half empty. I'm talking about abandoned, completely abandoned. People are just sleeping in there. People are vandalizing the place. It's a bad situation that's going on, but it's not really being addressed. Malls across America are at risk of closing. These are the statistics depending on the mall grade here. You can see for yourself. 334 malls that qualify as C and D rated are at a high risk of closing. Okay? But it just depends. Ultimately, it really just depends. Since 2008, commercial real estate services firm CoStar Group has been tracking the amount of retail square footage slated to close annually. Already in April, more than 90 million square feet of space is expected to be vacated. That's just massive. It's easily on track to surpass a record 105 million square feet of space shuttered last year. Millions of square feet of space in these years here are just empty. That used to bring in money, that used to generate, some revenue, that used to have an impact on the economy, and now it is simply empty. Huge, big news that's going on right now. Thousands of stores are going dark in 2018. The latest closures announced by Toys R Us added to an industry-wide headache shared by the retailers and real estate developers. By the end of March, more than 76 million square feet of retail space was already slated to close this year. Talking about more of the same details, okay? The friction is putting pressure on landlords to drop rents. There are not enough folks in retail moving in. I'm going to show you the map right here. You could see all of the different places. If I put my mouse around, this is actually interesting out of CNBC. They took the time to sort of plot these on the map, and you can look in your city, your state, or region to see that. Of course, the link will be in the description under sources if you're interested. This is just a long list. I'm not going to scroll through it all, but these are the 2018 retail closings. The latest news, apparently, Sears and Kmart. You can see the actual store locations they mentioned here. Previously announced store closures: Subway's closing 500, Bon-Ton, 256 stores, GNC, Toys R Us, and so on. J. Crew, whatever. It goes on in the whole list. That's just you can scroll for 10 minutes and see how many. And that brings me back to my original point. Is it the problem of these retail stores? Are they not making enough money for their shareholders? Are they not trendy anymore? Are they, suffering in some sort of way that makes them want to choose another retailer instead of them? Well, I propose to you that the issue is the economy itself. That is the primary issue. Look at this. Personal savings rate. You can see that this has been declining just for decades and decades. All right, so I'm going to look at this from the financial crisis. By the way, when I see something like this here, I consider it to be an anomaly, and I sort of flatten out the curve. Okay, so this is 2008. It picked up and then it declined. All right? Because quite frankly, the savings rate at 11%, I'm not buying it. 7.5%, even if we take it up to these levels here, people don't save. They don't save, and as time goes on, they save less and less and less. That's the way I see it. And this chart basically shows us that people are spending more now than ever. They don't want to save money. It's not worth it for them. They don't want to save their money in the bank. They get no interest, so they just buy stuff. They may be investing, but they're probably just spending. The Federal Reserve's plan for accelerating the pace of monetary policy tightening might be running into some trouble. Investors have unwound the bets of the Fed will pick up the pace of interest rates increasing over the next few years as political and financial turmoil rattles the countries such as Italy, Turkey, and Argentina. That's right. You said you were going to do it, but as soon as there was a little bump in the road, you decided maybe you'll hold off. The Fed has penciled in 3 rate increases for 2018. Investors still see a roughly 75% chance of that happening. I'm not exactly sure how they're going to do so. I hope they do, so we can bring in the inevitable crash. Just get it over with. Just get it over with, really. Okay? It would be nice. All right. This here is talking about Deutsche Bank and basically, how their situation is going right now. The Fed apparently had downgraded Deutsche Bank's operations in the U.S. This was last year. It came out now just recently. Ultimately, it's insignificant. I just found it funny that the Fed, I want to call it a company, but a quasi-government corporation, maybe, something like this, has talked about Deutsche Bank being insolvent. Meanwhile, the Fed prints money out of thin air. What do you even call that? Is that solvent? They're both, as far as I'm concerned, should be eliminated. But anyway. And then we have the problems going on with Italy. The main rating agency's stance on Italy's sovereign debt. Moody's on Friday threatened to cut Italy's debt ratings, citing risks that a new government weakens public finances and retreat from previous reforms. They have the 3rd largest public debt in the world, totaling 2.3 trillion euros. And that said that basically it's vulnerable to a rise in refinancing costs. If interest rates rise, we have big problems. Okay, so there's a lot to be concerned about. If you look at the VIX index, obviously that does not correspond. I think it's a joke. And the market just keeps going up. Ultimately, when you look at the bad news, then look at the market, it could still rise, which I find funny but also sad at the same time. So this is what we have. This is the situation. I'm going to keep covering it. I'm going to show you where I see the fraud, and I hope that you found it informative. If you did, please give me a thumbs up. And last but not least, if you found this video informative, I know you will find my books, The Money GPS, and my newer release, Global Economic Collapse, even more informative. You can actually flip through these books. All you got to do is go over to Amazon. There's a look inside feature that will allow you to flip through the pages of these books to see if you like them. Take care.